You've got $340 sitting in a checking account earning literally nothing. A Robinhood app you downloaded 8 months ago and never opened again because it made you feel a specific flavor of anxious and a vague, low-grade guilt every time somebody older than you says the words compound interest, like it's a magic spell you should have already cast by now. Let's actually fix that today, because nobody ever explained this to either of us properly, and I am personally tired of pretending I understood it the first 6 times someone tried to explain it to me at a family barbecue while holding a paper plate. Here's the uncomfortable starting point, and I want you to actually sit with it instead of scrolling past it like every other stat you've seen this week. Only about 36% of Gen Z currently has any investments at all: stocks, funds, crypto, anything. Compare that to 45% of millennials and roughly half of Gen X and boomers. And of the Gen Z people who are investing, more than half have $1,000 or less in their total. Not because Gen Z is bad with money. Not because we're all out here buying iced coffee instead of index funds like some finance bro TikTok with a Lambo rental wants you to believe. It's because nobody actually sat us down and explained what a stock even is in language that wasn't either a boomer lecture full of phrases like back in my day, or a guy screaming into a ring light about a coin that's about to 100x by Friday. Trust me, bro. So today, no Lambo, no screaming, no coin, just the actual mechanics, explained by a man whose entire portfolio currently consists of one coffee subscription and a lot of regret. Let's start with the basic thing. Nobody explains clearly, because everyone assumes you already know it and then just skips straight to yelling acronyms at you. A stock is just a tiny slice of ownership in a company. That's it. That's the whole concept, stripped of all the jargon. Think of a company like one of those enormous novelty birthday cakes, the kind that feeds like 400 people, and somebody's cut it into thousands, sometimes millions, of tiny slices. Each slice is a share. When you buy a share, you're basically walking up to that cake and saying, "I'll take that slice, please." And now you own a real legal tiny piece of it. Proportionally, your slice of the company's stapler budget, its office plants, its CEO's questionable LinkedIn posts, all of it, at a scale so small it's almost funny to say out loud. When the company does well, makes more money, grows, sells more stuff, doesn't do anything catastrophically unhinged in a shareholder call, your slice tends to become worth more. When it does badly, your slice is worth less. And you might be sitting there going, okay, but why would a company want to sell pieces of itself to random strangers on the internet in the first place? Genuinely good question, and the answer's more relatable than you'd think. Building a business is expensive. New equipment, more staff, expanding to a new city, just straight up surviving a slow month. Companies need cash for all of that. And instead of going to a bank and borrowing money, they'll owe back with interest for years. They can sell tiny slices of ownership instead. And that money is just theirs. No repayment required, in exchange for handing out a piece of the pie. Let me actually walk you through this with a story, because the concept clicks so much faster with a real example instead of me just throwing vocabulary at you. Say your friend Jordan wants to open a bubble tea shop. Jordan's done the math and figured out he needs $100,000 to open the doors, lease, equipment, that one specific boba machine that costs more than a used car. Jordan's only got $50,000 saved. Instead of taking out a loan and being chained to a bank for the next decade, Jordan splits ownership of the shop into 10 equal shares. Since Jordan's putting in half the money himself, he keeps 5 shares, each worth $10,000. Then he sells the other 5 shares to people who believe in the shop. You buy one of those shares for $10,000, which means you now own 10% of Jordan's bubble tea empire. With your money and 4 other investors' money, Jordan's got his $100,000, the shop opens, and everybody goes back to their lives. Fast forward 5 years. Jordan's shop is doing insanely well. He's opened 3 more locations, and the business that started out worth $100,000 is now valued at $300,000. Remember your one share. The 10% you bought for $10,000. It's now worth $30,000. If you sell, that's a $20,000 profit just for believing in a bubble tea shop early and doing absolutely nothing else. Not bad. But, and this is the part everyone conveniently forgets to mention when they're hyping up a stock, it doesn't always go that way. Say instead, Jordan's shop got crushed by 3 other boba places opening on the same block, and the whole business ends up only worth $80,000 instead of growing. Your 10% share is now worth $8,000, which means you just lost $2,000 of your original investment. That's the actual real unglamorous risk side of owning stock. And it's exactly how this works at scale with real public companies. Just with a lot more zeros and a lot more strangers involved instead of one guy, from college. Some companies also share their profits directly with people who own shares, through something called dividends, which is basically the company saying, hey, we did well this quarter. Here's a literal cut of the profits just for being an owner, which is a genuinely nice surprise the first time it happens to you and you have absolutely no idea what it is. So where does all this actual buying and selling happen? At a stock exchange. Think of it like the marketplace where all these tiny company slices get traded all day. The 2 big ones you'll hear about constantly are the New York Stock Exchange and the Nasdaq. You don't have to physically go anywhere anymore, obviously. It all happens through an app on your phone now, which is either extremely convenient or extremely dangerous depending on your relationship with impulse control at 1 a.m. And real quick, because this trips people up. Not all stock is the same flavor. There's common stock and preferred stock, and it's basically the difference between a regular concert ticket and a VIP ticket. Both get you in the building, different perks once you're inside. Common stock is what most people mean when they say, I bought stock. You get voting rights, meaning you can technically vote on big company decisions. 1 share equals 1 vote. You might get dividends, but they're not guaranteed. If the company has a bad year, they can just not pay them. The upside is common stock has the highest potential for growth if the company does well. The downside is if the company goes bankrupt, common stockholders are literally last in line to get paid back after everyone the company owes money to, which sometimes means getting nothing at all. Preferred stock is the more responsible older sibling. You usually give up your voting rights, but in exchange you get more reliable, fixed dividend payments, and if the company goes under, you're ahead of common stockholders in line, just still behind actual debt. Less risky than common stock, generally less explosive upside too. Most people your age, if they're investing at all, are dealing with common stock, and that's genuinely fine. Just know the difference exists, so nobody can talk over your head about it later. Now here's the part that should actually make you a little mad on behalf of past you. The version of you that could have started this 2 years ago and didn't, because nobody explained it right. You could just leave your money in a bank account, sure, and a bank might pay you 1 to 2% interest a year, which is basically the financial equivalent of a participation trophy. Or, historically, the overall stock market, meaning a broad basket of it. Not one lucky company has returned an average of a little over 10% per year, averaged out over long stretches of time, ups and downs fully included. Crashes included, recoveries included, all of it smoothed together. That number sounds small when you say it out loud, which is exactly why nobody your age gets excited about it. Because we grew up watching people scream about crypto doing 40% in an afternoon and then losing all of it the following Tuesday. But 10% a year left completely alone, compounding quietly in the background while you live your actual life, is an entirely different animal than 10% once. Compounding just means your gains start earning their own gains, which then earn their own gains, in a stack that keeps growing on top of itself. It's not 10% of your original deposit every single year forever. It's 10% of an amount that keeps getting bigger, like a snowball that's been rolling downhill since before you started paying attention, which is exactly why the people yelling at you to start young aren't wrong. They're just genuinely terrible at explaining why, because they usually just say the word compound interest and then walk away like they dropped a mic. So let me actually walk you through the math instead of just gesturing vaguely at it like everyone else does. If you invest $200 a month starting at age 22, and it grows at that historical roughly 10% average, by the time you're 62, you're looking at over $1 million. And here's the part that should genuinely make your jaw drop. The actual cash you personally put in over those 40 years is only a small fraction of that final total. The rest, the majority of it, is compounding quietly doing the heavy lifting while you were busy living an entire life. Having jobs, breakups, terrible roommates. One specific era of your life you don't talk about anymore. Now here's the flip side. the part that actually explains the anxiety a lot of us are walking around with. If you wait until 32 to start that exact same $200 a month, you end up with dramatically less by 62, not because you invested for dramatically fewer years. You still invested for 30 solid years, which sounds like a lot, but because you missed the 10 years where the snowball was smallest and slowest and, annoyingly, those early years are also the most structurally important 10 years for the whole compounding machine to actually work. The lesson here is genuinely not, you've already lost. Might as well give up and buy the coffee. The lesson is that the version of you sitting on cash right now, telling yourself you'll figure it out later, once you have more money, once things calm down, once you get that promotion, that version of you is quietly making the single most expensive decision in this entire story. One invisible day at a time, and nobody sends you a notification for it. Which is exactly why it's so easy to keep putting off. Now, the not financial advice disclaimer, and I want to deliver this one with the full sincerity of a man whose entire personal investment history is a coffee subscription and one embarrassing meme stock purchase in 2021 that I do not wish to discuss further on camera. I am a cartoon guy in a permanently wrinkled shirt with a lanyard I did not personally choose the font for. Please do not take specific stock picks from me. Obviously don't build your whole strategy around Jordan's fictional bubble tea shop either. Please talk to an actual licensed financial advisor about your specific situation, your specific income, your specific risk tolerance, your specific everything, because this video is general education, not a personalized plan, and my legal team is currently just one increasingly concerned intern who reads these scripts and sighs audibly. That disclaimer delivered. Here's the actual practical stuff. The stuff I genuinely wish someone had explained to me clearly instead of just saying, just start investing. Like that phrase means literally anything useful on its own. Which it does not. It's the financial equivalent of telling someone lost in a forest to just find the road. First, index funds. And I promise this is more interesting than it sounds. An index fund is basically a big pre-made basket of hundreds or thousands of different companies' stocks, all bundled together into a single thing you can buy. Instead of picking one bubble tea shop and hoping Jordan doesn't do anything unhinged, you're buying a tiny slice of hundreds of different Jordans across dozens of industries at once. Less exciting, sure, no dramatic chart to obsessively refresh, but historically the most reliable long-term way regular people build wealth, specifically because you're not betting your future on one single company's fate. Second, time in the market beats timing the market. And yes, I know that phrase sounds like something printed on a mug next to a sailboat, but it's backed by real behavior data. A recent survey found Gen Z investors were more than twice as likely as boomers to name timing the market as their single biggest investing challenge, meaning a lot of us are sitting on cash, waiting for some perfect, obvious neon sign moment to jump in. That moment does not exist. Nobody, not even professionals with entire teams and supercomputers, can reliably predict short-term market moves. What actually works, boringly, is putting money in consistently on a schedule regardless of that week's headlines, which smooths out the scary weeks and the euphoric weeks into one long, steady, unglamorous upward line. Third, genuinely fascinating once you sit with it. Around 23% of Gen Z currently say cash, like a high-yield savings account, is the best investment for the next 10 years. For money you might need soon. Genuinely fine. That's what an emergency fund is for. But for money you're not touching for a decade or more, sitting in cash means you're quietly losing value to inflation while the market's historical average does its snowball thing entirely without you. Cash is a great short-term tool. It's a bad long-term growth strategy, and a lot of us are using the wrong tool for the wrong job. Here's the counterintuitive part nobody's really saying. You do not need to be rich to start. You do not need $10,000, a huge amount of the "I'll start once I have real money" mindset is backwards, because the whole point of compounding is that time matters more than the size of your first deposit. $20 a week, invested consistently starting now, genuinely beats waiting 5 years to start bigger, purely because of how much longer that money gets to snowball. Most modern investing apps let you start with basically nothing. Fractional shares, no minimum. No gatekeeping guy in a suit behind a mahogany desk deciding if you're serious enough. That gatekeeping used to genuinely exist. It mostly doesn't anymore. And almost nobody under 30 seems to know that. So, look, you're not behind because you didn't start at 16 with a trust fund and a family. Friend who works in finance. You're not bad with money because nobody explained any of this to you in school. Which, genuinely, why do we spend actual class time on the area of a trapezoid? I have used a trapezoid 0 times as an adult. I have thought about compound interest approximately every single day since I turned 25 and started paying my own rent. What you actually need is boring, unglamorous, and completely doable right now with whatever amount of money you currently have, even if that amount is embarrassingly small. An index fund, a small consistent contribution on a schedule, and enough patience to leave it alone while it does the slow, unglamorous, extremely effective thing it was designed to do this entire time. That's it. That's the whole secret an entire industry has spent years dressing up as some complicated genius move that requires a course, a mentor, and $300 of your money to unlock. If you want more of this, the actual mechanics behind building wealth, minus the Lambo screaming, minus the guru energy, minus anyone trying to sell you a system. Subscribe, so future me can keep explaining the stuff nobody bothered teaching either of us the first time around. One lukewarm iced coffee at a time. Okay, going to go stare at my $340 with a newfound, slightly unsettling sense of purpose. See you in the next one.